There are three things happening to senior bank accounts right now. Not next year, not someday down the road, right now, this month, in accounts all across the country. The first one can quietly drain money out of your checking account before you even realize what happened. And it is targeting a group of people who have been completely blindsided because they did everything right for decades. The second one is more aggressive. It gives financial institutions the legal authority to freeze, hold, or delay your own money based on a judgment call made by a computer algorithm. And the rules around it just changed in 2026 in ways that most seniors have not heard about. And the third one is happening so quietly that it has already hit millions of accounts, and the people who lost money did not find out until they checked their balance and something was missing. Here is what makes all three of these dangerous. Every one of them was designed to happen silently. No advance phone call, no letter in plain language explaining what is about to occur, no warning that arrives in time for you to do something about it. You are supposed to find out the month your balance comes in short, and by then, the money is already gone, or already held, and the window to respond easily has already narrowed. Stay with me until the end of this video because there is one more thing I want to tell you before we are done. For one of these three changes, the majority of the people being affected right now already have a way to protect themselves completely. They have it today, and almost none of them are using it because nobody told them it existed. Before we get into all three of these, subscribe right now and turn on the notification bell. The rules that govern what banks and financial institutions can do to your accounts change constantly, and the changes that hurt you are almost never the ones that make the news. The people who know about them in time are the people who protect themselves. The people who find out after the fact are the people who spend months trying to get their money back. Subscribe and let us get into it. Let me start with the first change because it is the one most people watching this are going to assume does not apply to them. And that is precisely why it is catching so many people off guard. It involves what happens to your bank account when you have any outstanding federal debt, and the specific type of federal debt that is now back in active collection after years of being paused. The Treasury Offset Program is a federal collection mechanism that allows the United States Treasury to intercept money from certain payments, including Social Security benefits, tax refunds, and in some cases direct deposits, to satisfy outstanding federal debts. This program was significantly paused during the pandemic years for certain debt categories. Those pauses have ended. The collection machinery has been switched back on. And the category of debt that is now generating the most unexpected bank account impacts for seniors is defaulted federal student loans. Now, I can already hear what some of you are thinking. You are thinking this does not apply to you because you do not have a student loan. And you may be right about your own education, but stay with me because this catches people in two ways that most people do not expect. First, the pause on collections lasted long enough that many borrowers stopped thinking about the debt entirely. It sat there, accruing in some cases, while people built lives around budgets that did not account for it. The pause ending does not erase the debt. It reactivates the collection mechanism. And the mechanism can reach directly into the payment that lands in your bank account before your bank receives it. Second, and this is the part that stings the most for older borrowers, this is not only about people who borrowed for their own education. This is about parents and grandparents who co-signed loans or who took out what are called Parent Plus loans to help a child or grandchild through school. That loan has your name on it. If it fell into default while the pause was in place and you assumed the problem had resolved itself, the Treasury Offset Program now treats it as your debt. And your bank account deposits are on the table. Here is exactly how it works so you understand the mechanics. When a federal student loan is in default, the Treasury can intercept up to 15% of certain federal payments before those payments ever reach your bank account. The protection that exists is that collectors are supposed to leave you with at least $750 per month. But think carefully about what that means in real numbers for a real household. If your monthly Social Security deposit is $1,400, which is close to the current average benefit, 15% is $210 taken before it ever touches your account. On a fixed income where that $1,400 was already carefully budgeted down to the last dollar, $210 is not a minor adjustment. It is the electric bill. It is 2 weeks of groceries. It is the copay at the pharmacy for 3 months of medication. And it appears in your account simply as a shorter deposit with no explanation attached. Think about what this looks like from the perspective of a 70-year-old woman in a small town in Georgia who retired from a hospital job after decades of service and who co-signed a student loan for her grandson years ago because she believed in him and wanted to help. The loan fell behind. Life moved on. A decade passed without anything happening. Then one month, her deposit came in nearly $200 short. No phone call before it happened. No letter explaining why in language she could understand. Just a short deposit and a growing sense that something was wrong. The collection did not happen because she did anything wrong that month. It happened because a switch was flipped in a federal building she will never visit. Estimates suggest that approximately 450,000 Social Security recipients are currently exposed to this kind of offset as federal student loan collections have restarted. Many of them are living on those deposits and nothing else. So here is what you do about it, and hear this part carefully because this is the piece almost nobody knows to use. If there is any federal student loan with your name on it, whether it is your own loan or a Parent Plus loan you took out for a child or grandchild, you have real options available to you right now before the short deposit appears. The first option is hardship relief. You can apply to the Department of Education to pause or stop the garnishment on the grounds that taking that money would leave you unable to cover your basic living expenses. This is a documented, established option, and it works for people who qualify based on their income situation. The second option is getting the loan out of default entirely through loan rehabilitation, which involves agreeing to make a series of small, affordable payments for a defined period, after which the loan comes out of default status and the offset stops. The third option for some borrowers is loan consolidation, which can bring certain defaulted loans current. Once the loan is out of default, the Treasury Offset Program can no longer intercept your deposits. The information and the pathways to do all of this are available at studentaid.gov. The point is this: the door is not locked, but it only opens if you move before or right when that deposit starts coming up short. Do not wait for the short check to tell you something is wrong. If there is any federal loan with your name on it, call the loan servicer this week. Ask specifically about hardship options and rehabilitation, and find out where you stand before the offset begins, rather than after. Now, I want to make sure you understand something before we move to the second change. The situation that traps people in this first scenario is almost never about the money being truly unrecoverable. It is almost always about not knowing the options existed until it was too late to use them easily. The relief is sitting in federal programs that affected people qualify for. The paperwork exists. The pathways exist. The problem is information, and that is exactly why we are here right now. The second change is the one that does not care whether you have any debt at all. This one can affect seniors with perfectly clean financial histories, no defaults, no outstanding obligations, nothing. And it involves something that is happening inside banks right now in 2026 that has significant implications for how quickly you can access your own money. What we are talking about is the expansion of automated transaction monitoring systems that banks are now required or strongly encouraged to use for accounts belonging to customers 65 and older, specifically in connection with elder financial exploitation protection laws that have been passing at the state and federal level. These laws were created with genuinely good intentions. They exist because elder financial abuse is a real and devastating epidemic in this country, with seniors losing tens of billions of dollars per year to scams, fraud, and exploitation by bad actors, including, in some cases, people within their own families. The legal framework that has been built to fight this gives financial institutions significant new authority to intervene when their automated systems flag a transaction as potentially suspicious on an account belonging to a senior customer. The specific authority that most people do not know about is the ability to place a hold on a transaction or a disbursement for up to 15 business days when the bank's monitoring system generates a fraud flag. This is authorized under a FINRA rule that has now been adopted in some form by more than half of all U.S. states. And starting in 2026, major financial institutions have been implementing significantly more sensitive monitoring algorithms, specifically for accounts held by customers 65 and older. What this means in practical terms is that transactions which would process without any delay for a younger customer may trigger an automatic review and hold for a senior customer. A large wire transfer to pay a contractor for home repairs. A significant cash withdrawal for a planned expense. An unusual deposit followed quickly by an outgoing transfer. a payment to a new payee that the system has not seen before. Any of these can generate a flag, and a flag can generate a hold. And a hold means you cannot access that money for up to 15 business days while the bank completes its investigation. 3 calendar weeks. 3 weeks during which the bill that was supposed to be paid from that account does not get paid. The appointment that required payment cannot be completed. The time-sensitive transaction that needed to close simply does not close. And the hold arrives with no advance warning because the system generates it automatically without human review in the initial stages. Think about what this looks like for a 73-year-old retired teacher in Columbus, Ohio, who has been banking at the same institution for 40 years with a spotless account history. She writes a check to a roofing contractor for $8,000 to fix storm damage, and then 3 days later makes a wire transfer to a family member for $3,500. Her monitoring profile, built entirely on automated pattern analysis, generates a flag for unusual large outgoing transactions in a short period. The hold goes on. She finds out when the roofing contractor calls to say the check has not cleared. She calls the bank. The bank tells her the account is under review for potential fraud protection. She explains that both transactions are legitimate and that she authorized them herself. The bank tells her the review must be completed before the hold can be released. She has no idea when that will happen. The contractor moves on to another job. The roof stays damaged longer than it needed to. And she did not do a single thing wrong. The frustrating reality is that the system cannot tell the difference between a genuine fraud situation and a legitimate large transaction made by a competent senior managing her own money. It flags based on pattern deviation. And for seniors who may have more irregular transaction patterns than younger customers with regular paycheck and bill payment cycles, the deviation threshold gets crossed more easily. What can you do about this? The most effective single step is to designate a trusted contact person on your bank accounts if you have not already done so. A trusted contact is someone whose name and contact information is on file with your bank, who can be reached by the bank when a transaction is flagged, and who can confirm on your behalf that a transaction is legitimate. With a trusted contact on file, what could be a 15-day investigation can often be resolved in a 15-minute phone call. The bank calls your trusted contact. Your trusted contact confirms the transaction was legitimate and authorized. The hold is released. To add a trusted contact, call the customer service number on the back of your debit card and ask specifically to add a trusted contact to your account. Give them the name and phone number of whoever you trust most to confirm your banking decisions on your behalf. This is a protective designation, not account access. The trusted contact cannot make transactions. They can only verify your intentions if a question arises. This step costs nothing, takes about 10 minutes, and it is one of the most important things you can do for your banking security in 2026. You should also set up low balance and transaction alerts on your accounts if you have not already done so. Most major banks allow you to receive a text or email notification the moment any transaction above a threshold you specify occurs on your account. If a hold is placed or a transaction is flagged, an alert system means you find out in real time, rather than when you try to make a payment and discover the account is restricted. Set your alert threshold at whatever level makes sense for your typical account activity. The goal is to know immediately when something unusual happens with your money, so you can respond before any hold becomes a bigger problem. Additionally, if you are planning a large or unusual transaction, consider calling your bank in advance to let them know it is coming. This is not required, but proactively notifying the bank that you are planning to send a wire transfer or write a large check to a contractor or make an unusual withdrawal gives their system and their human reviewers context that reduces the likelihood of an automatic flag. A 5-minute phone call to notify the bank before a large transaction is genuine friction prevention that can protect you from the 15-day hold friction on the other side. And now the third change, and this is the one I told you at the start is the quietest of the three, which is exactly why it is reaching the most people without their knowledge. It involves something that has been quietly altering the way interest income from savings accounts and certificates of deposit is being treated for certain senior account holders. And the specific population it is catching is people who moved their savings into higher yield products in the past 2 years, when interest rates climbed significantly, and who did not fully adjust their tax withholding to account for the new interest income those accounts are generating. Let me explain exactly what is happening. When interest rates climbed to their highest levels in decades over the past several years, millions of seniors did exactly what made financial sense. They moved their savings from accounts earning almost nothing into certificates of deposit and high-yield savings accounts earning 4, 5, and in some cases closer to 5.5% annually. A senior with $100,000 in savings went from earning perhaps $100 or $200 per year in interest to earning $4,000 or $5,000 per year in interest. That is a meaningful improvement in income. But interest income is taxable at the federal level and in most states. And many seniors who made this move did not adjust their tax withholding, did not make estimated tax payments, and did not account for the additional taxable income in their planning. The result is that when tax season arrived, these seniors found themselves with unexpected tax bills that they were not prepared for. And some of those bills arrived with underpayment penalties on top of the owed tax because their withholding had been set based on income levels that were substantially lower than what the high-yield interest generated. But here is where it intersects directly with bank accounts in 2026. The IRS has a provision called backup withholding that allows it to require banks to withhold 24% of certain types of income payments, including interest income, directly from the account before the payment is credited to the account holder. Backup withholding is triggered when a taxpayer has failed to correctly report their taxpayer identification number, has been notified by the IRS that they are subject to backup withholding due to underreporting of interest income, or has failed to certify that they are not subject to backup withholding when required to do so. For seniors who receive significant new interest income from high-yield accounts in 2023 and 2024 and who did not report it correctly on their tax returns, the IRS has been sending CP 2000 notices, which are automated underreporter notices, identifying the discrepancy between what the bank reported to the IRS on Form 1099-INT and what appeared on the tax return. If those notices were not responded to correctly and within the required time frame, some of these account holders have been placed in backup withholding status. That means their bank is now legally required to hold back 24% of every interest payment on their savings account, or CD, before it is credited to their account. Not a small percentage, not a gentle adjustment. 24 cents out of every dollar of interest income, withheld directly at the account level before the money is ever credited to them. Think about what that looks like for a 76-year-old widower in Phoenix, Arizona, who moved his $180,000 in savings into a CD earning 4.8% in early 2023. That CD generates approximately $8,640 per year in interest. If backup withholding applies to his account, the bank is holding back $2,073 of that interest per year before it ever reaches him. He does not see a reduction in his principal. He sees less interest credited to his account than the certificate terms suggest he should be receiving. And if he does not know what backup withholding is, or that it can apply to his account, he may not understand why the credited interest seems low or who to contact about it. The way backup withholding gets resolved is by addressing the underlying IRS issue that triggered it. If you received a CP 2000 notice about unreported interest income and did not respond to it correctly, the first step is to contact the IRS directly at 1-800-8291-040 to understand what triggered the notice and what needs to be done to resolve it. If you are not in backup withholding, but you received significant new interest income from high-yield accounts in 2023 or 2024, and you are not certain whether you reported it completely, reviewing your prior year tax returns and amending them if necessary is far less expensive than the penalties that accumulate from continued non-reporting. If you are approaching tax season with significant interest income from savings accounts or CDs, and you have not yet made estimated tax payments or adjusted your withholding, talk to a tax professional about whether estimated payments are appropriate for your situation. The IRS Form 1040-ES covers estimated tax payments for individuals. Addressing the underlying tax situation proactively is what prevents backup withholding from becoming a problem in the first place. Let me now tell you something that ties all three of these changes together, because the thread that connects them is the same in every case. None of these three things were announced in a way designed to reach the people most affected. They were not sent in clear letters to bank account holders. They were not covered in the news in a way that reached the people who needed to hear it. They operate on a quiet assumption that the rules are public, and therefore that people will know to look for them. The people who get hurt by all three of these changes are almost never people who had no options. They are almost always people who had real options that nobody told them to use. Let me give you the action steps from everything covered today in a clear sequence you can start on this week, and every single one of them is free. The first action is to check whether any federal student loan, including any Parent Plus loan you may have taken for a child or grandchild, carries your name. If any such loan exists and is in default, or in a status you are not current on, contact the loan servicer and ask specifically about hardship deferment and rehabilitation options. The relevant information and contact tools are at studentaid.gov. Do not wait for a short deposit to tell you the offset has begun. The second action is to add a trusted contact person to every bank account you hold. Call the customer service number on your bank card and ask specifically to add a trusted contact under the Elder Financial Protection provisions. Give them the name and phone number of whoever you trust most to verify your banking decisions if a question arises. This prevents a routine large transaction from becoming a 15-day hold situation. The third action is to set up transaction and balance alerts on your accounts. Most banks offer this through their mobile app or online banking portal. Set an alert for any transaction above a meaningful threshold and for any balance falling below your comfort level. Knowing in real time when something happens to your account is the foundation of being able to respond before a small problem becomes a large one. The fourth action is to review the interest income reported on your most recent tax return against the 1099-INT forms you received from your bank or brokerage. If there is a discrepancy, or if you significantly increased your interest income in the past 2 years by moving into higher yield accounts, and you are not certain the income was fully reported, consult a tax professional about whether an amendment is warranted. The cost of addressing an underreporting issue proactively is substantially lower than the cost of responding to an IRS notice or a backup withholding situation. The fifth action is to share this information with someone in your life who is over 60 and managing bank accounts on their own. Send this video to that person. Post it in whatever group you are part of where other seniors are active. One of these three changes may be quietly affecting their account right now, and they have not heard a word about it. Let me close with a piece that I promised you at the beginning. The majority of seniors affected by the student loan offset issue, the first change we discussed, would qualify for hardship relief or rehabilitation options that would stop the offset completely. The relief exists. The paperwork exists. The pathway to keeping your full deposit amount intact is available for most of the people being affected. What is missing almost universally is the awareness that the option exists and the knowledge of exactly what to do to use it. That is the entire story of all three changes covered today. These rules count on the people most affected not knowing what to do. Knowing what to do is exactly how you protect yourself. Share this with someone who needs to hear it before the short deposit tells them something is wrong. Disclaimer: this video is created for educational and informational purposes only. The content presented here reflects personal opinions and general information gathered from publicly available sources, including YouTube, Google, news outlets, government websites, and various online resources. Nothing in this video should be interpreted as legal advice, financial advice, tax advice, or professional guidance of any kind. Laws, regulations, and bank and government policies vary by state, by institution, and by individual circumstances, and they change frequently. Every person's situation is unique, and the information provided here may not apply to your specific circumstances. Always consult a qualified attorney, a certified financial planner, a licensed tax professional, or another relevant expert before making any decisions about your bank accounts, your loans, your tax obligations, or any other financial or legal matter. The goal of this content is simply to provide general awareness and help you ask better questions when you speak with qualified professionals who can advise you based on your specific situation.